So let's take a look back at American presidents to see which were good for the economy and the market. And we're joined to do that by Mike Santoli and Jeff Bush, a strategist with the Washington Update. Gentlemen, thanks so much for joining us tonight. Appreciate it. I'm going to start with you, if I could, Jeff. You say that presidents can basically only bend the trajectory of the economy by setting up an environment that is more positive or negative for businesses and for investors and therefore the market as well, correct?
I believe so. The economy has a rhythm of its own, driven by much larger factors than any one president may control during their short tenure as president of the United States. And I think throughout modern history, say post-World War II, those trends have been demographics and innovation cycles.
Mike, Dominic Chu looked at the performance of the S&P. We're going to look at the Dow here. And of the modern presidents in the 20th and 21st centuries, Calvin Coolidge had the best performance during his time. He was lucky enough to be president during the roaring 20s. But then after Herbert Hoover's debacle, then you had Franklin Roosevelt, and his gains were 194%. Not too bad either. That was sort of backloaded because of the war, right?
Exactly right. I mean, if you consider the 12 years of FDR's terms, he did have a 9% annual gain in the Dow, which is about what the historical average is. But considering most of that was during the Great Depression, it's, I guess, a net positive. Calvin Coolidge is a great example, though, of the luck of timing, either good or bad luck of timing. You know, he came into office. His two terms exactly spanned the great years of the 20s after a bear market, after World War I. And then, of course, he gets out right before the 29 crash. Obviously, a business-friendly environment, too, so you can set a certain tone, but you can't really pick your moment necessarily in terms of where you are in the cycle.
And Jeff, Ronald Reagan's administration, you talked about innovation, and some would say his policies were innovative, but they created kind of a confidence level for businesses to take risk, and that resulted in a significant gain.
Absolutely. You know, Ronald Reagan was still riding the wave of demographics of the baby boom generation. Ronald Reagan came into effect when those baby boomers were hitting their prime earning years early in that cycle. So he had that tailwind behind him. And then he enhanced that by creating an environment of lower regulation, lower taxation, which gave those business owners confidence to then reinvest in their business. Capital expenditures break even were a lot shorter, and that gave them confidence to make those investments. Hence, investors followed that, prognosticating that the investments would do well over time.
And Mike, Bill Clinton, to some degree, also had the luck of the draw. He was president during the dot-com boom of the 90s, and that improved his performance as well, right?
Without a doubt. If you remember, of course, very famously, he came into office with the slogan of "It's the economy, stupid." While we were coming out of a shallow recession, it was a very frustratingly slow pace of growth when he started. One thing that did happen, though, while he was president, of course, he had a Republican Congress starting 2 years after he got into office, was the government budget went toward balance, and we had a very surprising, at the time, decline in inflation and interest rates. So all of that helped to foster this backdrop, of course, with the technology boom of higher equity values. And in fact, at the time, the longest economic expansion on record.
Jeff, you also gave us an example of how an administration and a president can dampen growth, and you point out George W. Bush's administration. I mean, timing is everything, but certainly some policies also played a role in that.
Without a doubt. George Bush was confronted with 9/11 and subsequently started two wars in the Middle East. At the same time, he also, seeing the projected surpluses in the federal deficit or in the federal debt, that he then reinvested that in a tax cut. And that tax cut, combined with the drain of the cost of the two wars, really put him at a disadvantage.
And Mike, it's too early to assess the Trump administration's impact on the stock market, but it has been, you know, coming at the tail end of what has been the longest bull market in a long time here, but we've still seen tremendous volatility return, haven't we?
You know, we've seen volatility, certainly, especially in the last year or so, although it's hard to really deny the fact that the election of President Trump did catalyze a burst of business confidence, and you saw the markets really dramatically reprice higher and basically get out of that kind of a little bit of a slow growth mindset that had set in before that. But he also took office, actually, when he was elected, the S&P 500 had basically been sideways for a year and a half. So there was a little bit of potential pent-up energy there. And you're absolutely right, though, in terms of not being able to make a final verdict 2 years in. 2 years into Ronald Reagan's term, the market actually had a big decline and only a partial rebound.
You know, Jeff, what role, if any, do you think Congress plays in the economic success of a president and an administration?
Well, I think a great example of that would be the later part of George W. Bush's second term, when clearly Congress was trying to incent home ownership, home development, real estate development around the country. And of course, we know that added to dramatically the financial crisis we had in 2008.
On that note, gentlemen, thank you so much.
Thank
Mike
you.
Santoli and Jeff Bush, who was with the Washington Update.